Good evening and welcome to a special meeting of the Board of Public Works and Safety. Tonight is a special meeting, and in lieu of a roll call, I will ask each participant to introduce themselves, beginning on my far right.
Ed Bell. Dan McMillan, Clerk Treasurer.
Craig Wiley, City Attorney.
Sandy Seward.
Thank you, Board. There'll be no minutes of the previous meeting to be approved tonight, no dockets of claims. The only order of business this evening is the health insurance proposal by Kristen Duncan. This evening, or the last meeting, I'll bring you up to date. The last meeting, this board approved the vision and dental insurance for 2017, along with the Medicare supplement for retirees over the age of 65. We also heard a presentation from the IAC Medical Trust, Representative Ann Cotton-Jim. So tonight, what we want to do is we want to hear a presentation from Kristen Duncan concerning the health insurance, and we will afford Kristen the same amount of time that we have for everyone else. So, Kristen?
Thank you. It's good to be here tonight, and we're going to talk about the health plan, and we're certainly going to talk about the health plan as it looks in a prospective basis, but we're also going to take a look at a little bit of the historical, just to bring you up to date, why we're kind of in the situation that we're in, a little bit of a predicament, but I think the self-funded structure has served the city and the employees over the last number of years. We've got some historical data we'll share with you on that here in a moment. But I'm going to just kind of start and go through a lot of this. I think a good news for you is that, the format that I'm using tonight is pretty consistent with what we've used in the past years. So that first page, what you see are the administration costs, which are a component of a self-funded plan where those expenses are shown to you, and you can see what they are. From a current to renewal, there's not a huge swing in that. The little increase in the Envision cost, which is your pharmacy benefit management, and then there's the reduction of the Affordable Care Act tax, the transitional reinsurance, which is sunsetting at the end of this year. The PCORI is a tax that will continue. So the administration costs for this past year were around $50,569. As we look to what's going to happen in 2017, that would be $47,905. So if we turn the page, this goes into a little bit of detail about the stop loss and implementation of the trust and how all this kind of comes together. So we bring over the administration costs from the prior page, and that's one of the first columns you see there. Then the city has two layers of stop loss protection. We have a specific protection which protects the city against risks on any one particular individual, and then we also have an aggregate protection which would protect the city as a group as a whole, and it limits the claims dollar amount to that maximum claims up there at the top, which is $695,000. And we're there. We're gonna exceed that, and any claims that exceed that $695,000 would be reimbursed by the stop loss plan under the aggregate provision. So kind of moving across that, you have the specific premium, you have the aggregate premium, and then the fixed cost per enrollee and the fixed cost for the group. And then you'll see the build rates. This is the amount that we've got. We set this amount based on what we feel like we need in order to sustain the trust. And one of the areas where we went off a little bit this past year is after the enrollment last year, we did lose a significant number of enrollees. We lost 8 families, we lost 2 employee-onlys, and 2 employee and spouses on the HSA, and then we lost 1 employee only on the traditional. So we had less money going into our trust. In fact, as I look at this same sheet from the 2016 renewal, the amount going into the trust is $93,000 less than what we had expected, and the total billed amount is $130,000 less. As far as, you know, the cost to the city is about $95,000 less than what we were expecting, and the total is down about $120,000. And those latter numbers include the HSA contribution. So we have the billed amounts, and from the billed amounts, we take out the fixed costs that are necessary to operate the plan, with the balance going into the trust. And so based on this current enrollment, this is a situation where we had $546,481.56 going into the trust, and we needed that number to be closer to the $695. Again, the difference being the enrollment. We also had a little bit of a trust balance at the end of last year too, that we were kind of counting on to be there, but we've since exhausted that. So if you turn the page, this is showing a renewal with the stop loss, keeping the same stop loss terms. One of the things that you will note is, and what is driving the problems, is our stop loss carrier is assuming that our claims for 2017 are going to be closer in proximity to what they are today, rather than what they've been in the historical perspective. And so they've bumped that stop loss, the aggregate attachment point, up a substantial amount, which then means we have to fund that in order to make the plan operate effectively. Of interest, despite the tumultuous year we are claims-wise, I don't feel like our stop-loss premium has spiraled out of control. In fact, it's one of the better renewals that we've seen. I think it's going up less than 10%, and that can be seen in the combined annual total right in the middle at the bottom. Under the current scenario, it's $313,000. With the renewal, it's $333,000. So not a huge jump. Our claims are what's driving the problem. As you look at that group total at the very bottom right corner, you'll see that that's $526,000 that goes into the trust. So we are short, so we have to figure out, okay, what are we going to do? How are we going to get up to the maximum level in order to keep the city safe? And so the next page is the same grid, but with this particular analysis, it shows a 46% increase into your cost. And that does deliver us that $924,000 into the trust. And the total premium for that will be $1,258,085. One thing I would like to point out, I know there was some discussion with run out, and we're going to talk about run out here again in a moment. When we transition away from the self-funded structure we're in, run-out claims will be an issue. When we go into this renewal, if the city accepts this renewal, run-out claims will not be an issue. We factor that in. So we're going to be taking those claims liabilities in under the 2017 plan year. So that becomes less of a risk, if you will. Okay. Any questions on that? I just did the next page. It shows a little bit of a twist. Basically, the next page, basically what I've
Go
shown.
back, I don't want to get caught up in this 46% increase. I don't want to really look at that.
Okay.
I just want to move on to the page that we're going to. So should I not pay attention to the 46% increase?
Absolutely. I
Okay.
mean, that's an increase. It's gonna cost more to the city, or it's gonna cost more to the employees, or a combination.
Okay.
And we'll have to figure out how to resolve that or mitigate that as best we can. Now, I think one thing that we should point out, and this might be a good time for me to hand out this document. This is showing some of the historical data. And on it, at the top, which, I put on there for your reference, it shows the cost per pay for the employees that have participated in the city's plan since the 2009 time period. But the point I want to, or the element I want you to look at this particular point in time, if we look at your claims history, in 2009, it was $944,000, and at that time, we had 118 people on the city's coverage. And that was a bad year. We managed through it, and the following year was 448,000, and you can see the historical data up until the current year. So our claims have been relatively lower than the $900,000. And so if we chunk $920,000 with a 46% increase into our trust and say we have $500,000 in claims for the 2017 plan year, the city's going to have $423,000 in the trust that can be used in future years. Will that happen? I don't know. I wish I could say. It might make your decision a lot easier on which direction to go. Any further questions? So the next page that I show is, we still have the same objective. We've got to get $923,000 into the trust. And so this next page, it basically shows increasing the funding rates by 29%. And instead of giving the employees an HSA contribution, the city just contributes what would have ordinarily gone into their HSAs into the trust. So the HSA contribution accounts for about $145,000 of annual expenses under the current structure. So if we back that off of the 923, we don't have as far to go with the build rates. And so that obviously would be a little bit lower of a cost increase to the employees and also to the city. At the end of the day, we're still getting $924,000 into the trust, which is the goal. Now, because we're self-funded, the city could make a decision, and the city could make a decision to fund at less than the maximum. They could fund up to the expected number. I did not run any analysis for that, but at some point, there has to be a safety net where you would dip into something in the event that the claims did run high for next year. So that's certainly a possibility that would give you some flexibility if you so desired. I don't know that I would feel comfortable doing that, but it is an option. You've got the claims history there to see that it has kind of worked out. Any questions? Okay, well then we'll move right into another option that I've put together for you, which is a return to the fully insured market. And I have a quote with United Healthcare. We gave them all of the information that they needed to prepare an analysis for us. And they have two plan designs, I think, that fit very closely to the plans that we have in place now. And if I could, I'd like to back up. When we talk about the self-funded plan, the part the employees see, the two plans, the traditional and the HSA, we have not discussed any kind of changes to the plan design. So our intent was to just kind of keep those plans in place as they are now, okay? So United Healthcare with their traditional plan, they have a $3,000 deductible in network, $9,000 out. And then once the deductible's met, the plan pays 100%. Out of network, it's a 70-30. Then the maximum amount of pocket is $6,250 in network, $18,750 for out. Incidentally, this is the same United Healthcare network that the IAC Trust is using, so that would be consistent among the options. Lifetime maximum will be unlimited, and then we have a copay structure there for office visits, $30 for primary care, $60 for specialists, and the virtual visits would be $25. Wellness exams are paid at 100%, and then we have prescription copays for Tier 1, $10, $35 for Tier 2, $60 for Tier 3. Specialty would be $100 or $300, depending on where the medication fell. Urgent care visits have a $100 copay, emergency room visits $300. The HSA, again, very similar, but it would be a little bit of a difference, primarily after the deductible. One note there, I've got the language per person. That's the same as the embedded, non-embedded, or it's the same as the embedded. Sometimes the embedded and non-embedded can get confusing, so I use the language per person. And so it would be a $3,000 in network, $9,000 out, and then the plan pays 100% thereafter. It has a maximum amount of pocket of $6,250, and the reason the maximum amount of pocket exceeds the deductible is because there are copays that apply after an individual meets the deductible. So for office visits, prescriptions, emergency room visits, and urgent care, the individual would pay those 100% until they satisfy their deductible. After they satisfy their deductible, then they would go into the copay structures. And so realistically, I think it's a fair assessment to say most people are going to end the year closer to that $3,000 mark than they will the $6,250. It would take 10 emergency room visits after satisfying your deductible in order for you to meet your maximum out of pocket. Those are the copays for office visits would be $30, $60 for the specialist, and then the virtual visits would be $25. Prescriptions, again, they have the same copay tiers after meeting the deductible. And then urgent care and emergency room visits are the same. And then I suppose, if you will, the good news is that when we look at the fully insured numbers, those are actually pretty consistent with where you're at today. And just like you guys talked about with IAC last week, when we transition away from the fully insured or the self-funded world going somewhere else, we do have the run-out claims, which would need to be taken into consideration.
All right.
Which, the run-out claims will pay regardless, because you've got yours, it's factored in, rather than if we go the other way.
Definitely, they're going to have to be paid.
They're gonna be paid one way or the other.
Right. Now,
Okay.
the question is do you get a claimant with a, $150,000 claim? That's $150,000 from the city.
Right.
If you get, that would be applied to your stop loss, and so there would be some limitation to that particular one individual.
Okay.
Now, what will that happen? I don't know. I think for this board's purposes, I know Ann gave a number of 137, something like that. And I don't know. I'm not really sure if we need to get hung up on whose numbers are different. I think, from an assumption standpoint, assume a consistent number. Unified did give a number that was a bit higher, and then on top of that, there would be administration costs associated with that, which I'm not sure if that was factored in. Was your number inclusive of admin fees? Probably not.
For the stop loss, probably not, because they're
Yeah.
looking at a percentage of claims only.
Right, okay. So we do have some admin costs that would be on top of that, which the admin cost would be about 11,000 according to Unified. They're putting the run out around 200,000. What does that work out to be? I don't know. I mean, what does that number work out to be? I don't think it's easy for Ann or I to say this is what it is. I think if you use that number, a consistent number, somewhere in that neighborhood, we're getting close. We're consistent at least.
Okay. I think what I want to do now is, there's only 3 employees on the insurance here. But I would want to open it up to where I can hear from them. Jim, Aaron, or Mark, you want to comment on this?
I have some questions, actually. 'Cause these are questions that we couldn't answer. I had to leave, the meeting lasted from 1 to 4 today, and I had to leave at 2:30. So I have some questions, and maybe the board could shed some light on it, because we didn't get a chance to meet with the IACT young lady. With IACT, would we continue with the 110, 220 HSA contribution?
That would be something that we would have to decide. The proposal here tonight, Dan and I had talked about that earlier on. A month or two ago, that might be one option. I don't know, Aaron.
Yeah, and we don't know either, because we haven't seen we've seen what the city side would be as far as cost per employee, and we have an idea of generally what that cost. We have a way of doing some funny math to figure out that we have an average of what that cost will be for employee. We just didn't know if the contribution was going to continue or not. Which a 26.9% increase versus, I think it's a 46% increase. So you would figure the one would be a little less per employee. So this is the question that we both have been tauntering back and forth, and we talked about in our meeting today is, what is the best route for the city? Staying self-funded, having full control of your insurance, able to make changes as needed, and having the ability to make corrections if something needs to be made, or going where we're not self-funded, we're going through a trust system, and to see where that goes. One's a 6-year trust, one's an 8-year trust, to see what the stability is of either one.
3-year.
No, we mean the history of.
Oh.
The history.
Two.
The
Okay.
history of the two, yeah, 'cause that's
Okay.
what we talked about was, what's stable? What does stable mean in the insurance world? So you have an 8-year trust and you have a 6-year trust. So, there's only 2 years apart, and they kind of both did this. These are all things we're weighing. By all means, I don't know that I have the right answers, because I'm not a weather forecast for insurance in any way, shape, or form. The other question that kept coming up in my mind particularly is, can the city continue to afford to come up with $200,000 when we're short in the fund? And does the city have the money to afford the run out along with paying the claims that have not been paid yet this year? Because the trust is technically broke at this point. And that's what I don't know.
My answer would be, no, we do not have the money to pay them run-out claims. It would have to be borrowed, and the trust would be responsible for it. We would get reimbursed, provided we went where we were self-funded. If we're not self-funded, we're gonna have to borrow money from somewhere, I don't know.
Okay. And then the other, I'll let you go ahead. Anything else? 'Cause you people you talked to.
Yeah, because the meeting went till 4, we had a lot of discussion during the meeting. I went back and I've talked to a couple of the employees, officers, Their concern is the 26% to the 46%. It's a lot of money, and the short part of it is 26% is better to them. But also, we want to know if the city will continue to pay their percentage that they have paid, and the employee pay theirs. It's 82 and 64, I think, that the city pays employee, and then for the city and family is about 64%. And if that is going to stay the same, and the 110 and 220 that the city applies to the HSA, the ones I've talked to want to go with the lesser amount. It's a hardship when you have a family, young officer, to try to come up with, say, $600, and then it goes up to $1,500. So we have some questions that the insurance committee talked about, but we can deal with that later. It's if the percentage is going to stay the same that the city pays, and if we'll get our HSA donation or money that the city pays. They told me they want to go with the IAC.
One comment on that, the United Healthcare was like 200,000 cheaper than the IAC. So why would they go with IAC if the other's 200,000 cheaper?
That was just their opinion. It's, maybe it's a almost guarantee that there's going to be an increase, and almost what the guarantee is on IAC or even the unified. We almost know what the increase is going to be. The United Healthcare, we don't know if there's going to be an increase. It probably will be. You suggest there's going to be a high increase. Everybody says health insurance isn't going down. But they were told what the increase could be, and they're willing to go with something that's pretty certain. 5% to 15 is better than a 26 or 46% for the next year's, not the one coming up.
The one insurance you're talking about, though, what was that? I call it the traditional, but it's not a traditional because that's the wealth you used to have. The problem with that insurance is we have a one-year quote. So we have a one-year quote, so if we have another bad year with that one-year quote, they can drop us like a bad habit whenever our insurance runs out, and then we're back to square one trying to figure out what to do next and how and where to go. And that's the big concern there.
Or vice versa, we can drop them like a bad habit too if we got a good year. And,
Yeah, because that's
so
monthly, it's technically a monthly
yeah,
contract.
it's actually, right.
That's the forecasting that
That's-
Aaron talked
that's
about.
like, yeah.
We don't know, and it's our best guess throwing a dart. And the few that I've talked to would like to throw the dart that way.
Yeah, I don't know that, and this is the conflicting part, and that's why in the meeting, the part that I was there for, it was kind of like, which way do you go? What do you do? Because we don't know, financially where the city is. Could they afford the run out and everything else where we would get some reimbursement somehow, kind of work it through with the trust system that we have installed and in place? Or is it better off to work the other angle because the possibility of better control of the rate, of the rise of rates that we might have? Or is it better to go with the single insurance, which I'm against because I feel like that insurance particularly nickels and dimes you to death at $30, $40, $60, $10, $20, to a maximum of $6,200 out of your pocket, but not including your copay. So if you go get a CAT scan, if you go to the doctor, you're still going to have those copays on top of the $6,200 you've already paid out. So I was completely against that because that's not the type of insurance we have now. So I doubt we helped you, but I hope we provided you information.
No, Jim, do you have a thought?
Just kind of echo what the chief was saying, the few I'm very, very much concerned about the massive increase in the premiums. So am I. And I definitely don't want to lose coverage either as somebody that typically uses the insurance every year. Been depending a lot on Aaron and his reports back. And we're, as a department, we certainly are interested in lesser fees or a lesser increase if all possible, and still try to maintain as close to or the same coverage as we currently have. So that's, again, I don't think that helps this board any. Just reporting back the conversations that's gone on at our department. So, thank
I'll
you.
open it up to board members' comments.
So I think my only comment that I have, Dennis, you said you wanted to come here tonight to make a decision. Are we ready to make a decision? Is the committee ready to make a decision? Are the employees all well-informed on what decision needs to be made? I'm going to be honest, it's very hard for me to sit here as a board member. I don't have this insurance, and I'm going to make a decision for other people. I need to hear from the employees. I want to know how the committee is, if they're leaning one way or the other, and also what is best for the city. That is my stance. And again, are we pushing to make a decision tonight, or does more discussion need to happen?
Running out of time, aren't we?
Well,
Goes
to make the
December
right
1st.
decision, I think it's worthwhile to, to take the time needed. My personal opinion, and I take this insurance, my first choice would be fully funded, or first choice would be self-funded. Second choice would be the United Health, and third choice would be IAC. And the self-funded, if you look across there, the employees had very little increases since 2009. And, it's a gamble one way or the other. Whether you go United Health or whether you go IAC, you're going to have an increase every year. And, 5 to 15%. Well, if they would have done that for the last 9 years, minimum would have been a 45% increase. I'm only going to be on it for maximum another 3 years. So, this,
But as the city, you're bringing it up, keeping it low, shouldn't we have increased it a little bit more? Then we wouldn't have had to worry
tried to
about
do
this
that
46.
we tried to do that the last 5 years, and the employees didn't want an increase.
So
And
now
now
this
you
is
see where we're at.
That's where we're at.
Yeah, so no matter which way they go, they're gonna get that increase at least, and probably more each and every year. From the city standpoint, the best way is the self-funded, because we don't have the means to pay for this run-out money. So,
You're saying that the self-funded is best for the city? Is that what you're telling me?
that's what I'm saying. That's my opinion.
Ed, your comments?
Well, I've been listening to the employees out here, and then Dan kind of flipping it a little bit. With the IAC, the way my understanding is, and what I've been looking at, is it's safety in numbers. That we only have X number of employees with the city versus a thousands out there going into a trust. So therefore, it does, with the city, have a better impact on, one, you're not going to get stuck with a 46%. You may have a 5 or up to, I think we were talking about even maybe an 8% or less, depending on our claims. But it seems like to me, it's easier to budget. You said you tried to budget 10%, and look what happened this time.
I
You know-
budgeted
you know-
10% for the past 5 years.
Right, exactly. But if you would do 10% next year, if we went to IAC, we'd be under control on that. we're gonna be paying the stop pay regardless, either upfront with the increase or going and the city having to bite the bullet to switch to IAC. But me, sitting there and trying to figure out a budget, it seems like to me it's a lot easier to do. The city is less risk involved.
Well,
There's a couple of things I would like to bring up. Historically speaking, when it comes to municipalities, and despite what the common thought might be in the insurance industry, it is not a very favorable risk to a stop-loss insurer. And part of the reason behind that is claims. Claims tend to be a big factor with a municipality. So although there are safety in numbers, I don't know that bundling yourself with a bunch of municipalities, which are historically bad risks, is going to be effective over the long term. I don't know. Maybe it will. Maybe the folks at IACT are going to do things a little bit different than other trusts that have failed. I don't know. Maybe it does work out. I think you lose a little bit of the control as far as the percentages of increases. Historical data is not necessarily indicative of a future performance. And so that is a big factor. I know everybody keeps talking about this 5 to 15% that we heard from the folks at IACT, but there's no guarantee that that's going to be what is going to happen. Look at our data and look at where we're at. So sometimes we do need to bring that into consideration. So, we just, and, when you guys are making a decision, the United Healthcare Fully Insured is by far the lowest of the options that are on the table by a decent margin. And I understand that some of the co-pays and so forth are going to be a little bit different, but I think it keeps everybody pretty much where they're at today with regard to their out-of-pockets. We could put the HSA contribution in, we'd be right in where we're at today. Are we going to see an increase in 2018 or for the 2018 plan year if you go with United Healthcare? I don't know. I would speculate most likely. What is that percent? I don't know. We've had United Healthcare quotes that come in 2 to 3% renewal, but I don't want to get caught up in what is this renewal going to be versus that renewal, because it's too difficult to project.
well, I remember earlier this year when Dan came to me and talked about his concern for the insurance here, the balance. And we were in trouble. And we talked about maybe looking at another option for insurance. I decided then that I am no longer going to support what we currently do. So, and I've made it perfectly clear. I made it when we met last week with the lady from IAC, and my vote will be not to renew our current self-insurance. If the board decides to go with the self-insurance, it'll be a 2-to-1 vote, but I will no longer support what we are currently doing. For the simple reason, we could be hearing this same 30% increase next year. If we go with IAC, we're getting an increase. And you know what? We might have been our own worst enemy by, like the clerk said, over the past 4 years. Maybe we should have raised our rates 5 to 10% each year. We wouldn't even be having this discussion right now. But as from my perspective now, I am not going to support this any longer. If the board decides they want to continue to support it, it will be a 2-to-1 vote. The HSA and traditional, I don't know. We'll have to weigh it out. and go from there. So I'll leave it up to the board. If they want to hear this matter this evening, I'm prepared to vote. If not, we can hear it at the December 5th meeting.
I want to hear, apparently the committee met for what, 3 hours today? You know, I wasn't there. You know, I didn't get all the feedback and the back and forth and the comparisons that you all were.
Well, and don't think that, we compared what Christian has offered us and
Right.
a little bit about IAC we know.
Right.
And I think that's part of the, like, so what all does this include? Where does the city fall with the, 110 to 220 per month contribution? And, as far as money out and those type of things, and after you pay the roughly around $400,000 to $200,000 unpaid claims, and if it just comes to fruition around the $200,000 for the runover of claims, where's the city going to be at financially, and what are we really going to be at as far as numbers for the employee side? That's a lot of stuff we don't know. 'Cause we haven't, I don't think anybody's dove in to figure that out yet. So we couldn't give that an honest, I feel like a full comparison that we can give the others, because we kind of know the numbers and where things were going to fall, or had a projected idea of those things were going to fall.
You know, but Sandy wanted to hear what the employees had to say. The employees that were at this meeting last Monday knew that we were meeting tonight.
Right.
This is one of the most important topics that we can discuss as a board, and there's 3 employees here.
I agree.
Which you see why it's hard for me to make,
There's
you know,
4.
a decision.
5.
Tom's not on the insurance.
Okay.
Mark, would you make the comments you made in the meeting today about the group, what you felt, that was,
I had a question about with IAC itself. Why does not IAC make all the cities a group? Instead of it being a group and then they individually pick out a city and say that city is going to get an increase of a certain amount compared to a different city maybe getting a different amount. I personally have a question why the group just doesn't get an increase, say, everybody gets 5% or everybody gets 10% instead of one city getting a different increase. I don't know if.
May I address that?
please?
Were you at my presentation last week where we talked about the renewal methodology? Actually, I would think that you would want this methodology that we do a little bit better. The first 2 years of the trust, 2011 renewal and 12 renewal, they were the same.
They need to stand up at the microphone.
Yeah, please.
I'm sorry. I appreciate your question. You saw the presentation about the annual renewals last Monday night. So a banding formula was put in place to keep the pooling methodology in place. So after you've been in the trust 18 months, you will get, your renewal will be based upon 70% of the entire trust and 30% based upon your claims ratio. So if you are having an excellent claims year, which Christian's talking about, hey, you've had these excellent claim years for a number of years in a row, you're going to want that credit. I mean, you're going to want that, because if you would go out to the marketplace, you would probably get a reduced premium, right? If we're only charging you what the trust average renewal is and not giving you maybe credit for your performance. Or, we're trying to keep this a fair and equitable methodology for the renewals. Or say your claims experience is well over 100% or 144% loss ratio, there's still the guardrails in place where you might get a little bit more than that average 5%, whatever the average happens to be, but it's never going to be in these double digits or 26 or 46% because we're keeping those guardrails narrow to where it's not excruciating for one specific group. So I believe, and the trustees believe, it's a very fair methodology. Instead of having everyone get a 10% renewal or a 5% renewal, you may have a 0.8% or you may have a 7 or 8%. But those guardrails are in place to still keep it well below medical trend and within a doable range to keep it fair and equitable for all. The Department of Insurance, as you know, regulates our trust. So we are funded based upon their premium funding regulations. So coming into the pool, we have to fund a maximum claim liability, not expected claims, plus all costs, plus run out. That ensures much stability in our program. We have $24 million in the bank that we're using to offset those annual renewals now and to provide additional services year after year. So the stability of the trust as a group insured, a large group pooled together is far better than being on your own for future stability. If you want to go year by year, then the trust is not the place for you or for the participants or for the city to be. It's really that long-term approach to stable health care without changing the plan designs and increasing deductibles or out-of-pocket maximums year after year, and stable services, and then a stable cost for you, that you can continue to beat medical trend and bend that curve. And that's the whole point of the trust, is to provide stability for employees and stability for the city's bank account. Does that help explain the renewal? You can ask other questions.
It's not so much the renewal that I have a question is, if it's just your policy, why you don't include everybody, that all the cities, the 37, or if we come in 38, why are not they all considered one group instead of a group, and then you individually pick out a city to adjust their rates? Is it just your policy?
For the renewal, so for example, going in, I guess I need to talk, sorry. For example, going into 2017, the underwriters and actuaries looked at the entire performance of the entire pool, not 37 individual cities and towns, the entire plan performance. What were our total claims? What's our total cost? Where's our reserves in place? What do we need as a global renewal to fund this trust for the ensuing year? So what do we need as a global renewal? That global renewal was actually a little higher. It was more like 8%. But we were able to use our reserves this year to buy that down to 5.5% as the average renewal. And then we looked at, for those that have been in the trust more than 18 months, which has been mostly everyone, you looked at their experience. And it's really for the outliers where it impacts, where if you've had a really large claims or if you've had really great claims year, that's where those adjustments come into play to give you a credit or maybe an additional debit. Again, with those guards, we're able to keep it safe. So the global pool is looked at to get that average percent increase. And then your, or the Beech Grove's experience to apply that banding formula. And I can give you the low and the high for 2017. We had the city of Bloomington with over 600 employees. They've had great claims experience over the last few years, and theirs was just literally right at a 1% increase. They were thrilled. We had a group that had 144% loss ratio for a number of years in a row. Their increase was 9.5%. On their own, it would have been 30 or 40%. Nothing went above that. Everything fell between that.
So
Does
it's
that
just your
help?
policy that everybody's grouped together, but then a city is checked.
We're looking at your claims
I
experience.
understand the 70s and 30s, but it's just your policy to where the group is considered and then a city is considered. That's just your policy.
That is the banding formula policy that they adopted. Instead of everyone saying, let's have everyone get a 7% increase across the board. Let's look at what we need totally and then look at the individual just for 30% of it. 70% of your renewal at that point is based upon the trust pool, because we have to have that pooling methodology in place or we shouldn't have a pool. And then 30% can true it up or down with guardrails that keeps it safe and stable for you in the long run. Does that help?
Yes, thank you.
Is there any other questions for Kristen? Kristen, you have a guest with you that,
Well, Todd Roberts is here, and he represents Unified, and he's here to support me. I'm not sure if he wants to say anything on behalf of
he's
Unified.
welcome to make a statement if he'd like. If not, that's fine.
I know, Christian, for me to stand up here and try to say $200,000 is not a lot of money, that would be silly. I know it is. But in the history of self-funding, some of those times we've brought reductions. When you're having an excellent claim year, that money's yours. You're not, in a fully insured environment, that money's theirs, it goes away. and you've built up years of money in that trust, and unfortunately, we're having that terrible year this year, that's kind of depleted that. As one of the committee members was talking about, another thing in self-funding is, total control of the plan design, and the ability to do that. Again, and I know I can't sit here and put a value on service and these things, I know this, the employees out there love dealing with us because they have a dedicated claims account manager they talk to every time. The personalized service, and I can't put a dollar figure on that, but I know, it's very beneficial to the employees that are calling in. And, we do go to the markets every year to several stop-loss carriers to try to get the best rates we can for the city. And so, the run-out, that is what it is. That's a projection on what, based on the claims experience so far, going on for another 2 months, and the unfunded claims, that we're dealing with. But again, the 2017 rates, once that contract's in place, you might be sitting here next year, and again, yes, we could be having another bad claims year. That's the part we can't predict.
But in all fairness, you could have a good claims year.
Yes, we could have a
Either way.
very good claims year next year, and then while a stop-loss carrier blends some of your years together, a really good claims year next year, you might be sitting here looking at a flat renewal, a 0% increase or a reduction for that matter, if the claims year was really good. So, again, I appreciate, the time to let me talk. We love doing business with you and so forth, and but like I said, the self-funded part of things are, it's worked for the city for several years, and then just unfortunately this year, we just ran into a very tough claims year, but I really appreciate your time. Thanks a lot.
All right, thank you. Board, you have two options. You can table it tonight until December 5th meeting, or you can call for a vote.
I have another question for Ann,
Go ahead.
if I may. Ann, so basically, we're sharing the risk with other municipalities, correct? And right now in IAC, there are 37 municipalities in this program, correct?
Yes.
Okay.
36, the newest one, that will be effective January 1.
That would be us. So we would,
be 38.
we would be 38.
37th one's coverage is effective January 1.
Okay, so how many municipalities have gone away from your program for 2017?
None.
None. So how many more additional municipalities have you received for 2017? Because that's going to make a difference, right? I mean, the more people that are on board, the more we share, correct?
You are exactly right. This is a pooling program. With, right now, you would be 38, 37, 36 currently on the plan. The 37th one will come on board January 1. We do have a few other proposals out that are being considered next week by two other groups. That's not going to impact your rates, but you are spot on with growth. The more we grow, the more we're spreading the risk, the more we're controlling costs.
And the more
So,
trust.
for example, a $60,000 legal fee, and I'm just giving an example for the year, now would get spread among 3,500 employees instead of 3,000 employees. So you're sharing in the risk, you're sharing in the cost for controlled stability
Didn't
going
you
forward.
lose the city?
Oh, not this year. We've only, since 2010, when we launched the trust, we have lost one group, and I talked about that last week. It was the city of Mishawaka. One group.
And the reason for that loss was the change of,
Local politics.
right, okay.
Yeah, not services, not the trust, not the design, not the
Okay.
program.
Can I ask a question?
Absolutely.
What percentage of your insured groups are now within their 3-year lock-in period so that they can't move?
What do you mean they can't move? So you start, if you would join in 2017, you would be coming on board for 3 years. And you're committed for 3 years, and then you can go year by year. There's not an additional 3 years after that. So who's ever joined in the last 2 years is still within their 3-year period. Everyone else is going year by year since 2010.
Basically, my point to that would be those groups would not be eligible to move. We don't know how many those are.
Oh, none of the others are moving because you have to inform the trust by April 30th if you're planning to leave the trust for the ensuing year, once you've fulfilled your 3-year
He's talking
agreement.
about they're in between the 1 and 3 years. They couldn't leave if they wanted to.
That is correct. I mean, they could leave, but they're just going to pay their own run out at that point in time. So if I had a group that joined, for example, the town of Munster joined 1 year ago, in 2016, if they said, gosh, Ann, I don't like this service, I don't like the trust structure, United Healthcare, we're pulling out. Fine, that's fine, you can pull out, but they're going to then pay their run out claims that they've incurred for the year. Even though we have fully funded that, that's just, if they leave before their commitment is fulfilled, you're going to pay your own run out claims at that point.
So if I could then, when would the city, if they decide to move to this effective January 1, when would their renewal date be?
Well, if they would move January 1, you're coming in knowing the premiums that I proposed last week. The Board of Trustees will meet in September for the 2018 renewal, so they will know what their increase is by the end of September of next year for 2018.
For January 1?
For January 1,
Okay.
yeah.
I thought you said that we would know in July.
No, I always give a placeholder in July because everyone's starting their budgets. We have to have claims through July. That's what our underwriters use when they're setting that renewal. So we have had all the rates adopted at the Board of Trustees meeting by their September meeting, with the rates being known by September 30th, because you would receive rates for all the plan options that we provide, so you could keep the same plans or you could choose other plans going forward within our menu.
So basically then, if we, I think with the city, the situation the city would be in, if I've understood this correctly, the rates would be published at the end of September for the following year. But if the city wanted to leave the trust, they would have to notify you by April 1st of the year prior, is that right?
If the city wants to leave the trust after their 3-year commitment, they simply let us know by the end of April, because we have all the underwriting to deal with, looking at the numbers, keeping the pool safe, looking at the stability and the number of lives they're covering. That is also fully disclosed in the trust agreement and declaration about the withdrawal terms.
It's very difficult for the city to make a decision to leave something in April when you won't know your rates until September. That's where I was going with it.
There's a 90-day where you can rescind that within 90 days.
Any other questions?
Thank you, Ann.
You're welcome.
I've got one comment. On the fully funded, or the program we got right now, the 46% increase funds that 100%.
To the maximum claims.
To the maximum claims. So if the maximum claims was 900,000, we only have 400,000 in claims, that 500,000 difference would go into the trust, which the employees would own.
I know this year looks bad when we talk about the overall claims and all that kind of stuff, and it can be a handful and can be overwhelming if you're not involved in it. And we've seen it. I've been monitoring it since March. Dan and I have been keeping in constant contact on it. The reality of it is that the city, because of our loss of enrollment, the city's cash flow has been down to the tune of about $130,000. And so are we going to have to fund some claims? Yes, but we've had $130,000 of savings. And anything over the $695, we're getting reimbursed for by the stop-loss carrier.
All right, board, you can table this until December 5th, or you can go ahead and proceed.
So we have 3 members here from Fire and Police. Are you ready to make a decision, or do you have more questions? I mean.
Okay, so I just told Jim couldn't attend the IAC meeting because he was giving turkeys out and things, so I just gave him.
Thank you for that, Jim.
And he now has something to tell you.
Yeah, Aaron just showed me all the breakdowns in costs and premiums and out-of-pocket costs, and For me, it's a no-brainer. The IAC plan is the way to go. As somebody that routinely maxes out their out-of-pocket costs, I like the fact of that savings right there. And if the premium increase is gonna be less than what we're predicting with our current plan, again, this is personal.
Right.
But I've got no qualms. I'd say let's do it, because I know I'm gonna do my out-of-pocket every year. That's a given for me and my family. So if I can save some money there.
If they go with IAC, you know your rates are gonna go up every year, between 5% and 10% at least.
Well, but yeah, we know what that is. And that's
And
not,
like
it's
the
not
clerk said a
a,
little while ago, maybe that should have happened from day one.
it probably should have.
We wouldn't have this discussion tonight.
Yeah, probably should have.
Yeah, personally, I like the stability and the trust. I mean, I like that, but again, I don't take this insurance, so thank you, Jim, for your perspective.
Okay.
Now, as a group, we have 2 members of the committee here, 3 members, 4 members. Where are we at, guys? As a representative of the employees of the city of Beech Grove, help us out here.
With the information that I think Aaron and I are in agreement that we have a choice, but we'd still like to have the numbers. What are we have an idea what the costs are. For us to go back and tell our employees that these are your costs, we'd like to know what they are. And is the city going to continue to fund the way they have funded? If we would say IAC and you don't fund it the same way, the cost could increase. Or one of the other, the unified, it's answers that I don't think that I can truly say, I can go back to my guys and say, this is what's going to cost you. And now, I don't know to tell them. I know about what it is, and I know what they've told me because about what it is. But I would like for you to table it, so we might be able to get some true numbers, and the city can tell us, yes, we are going to fund it in the same percentage, the same manner. Whatever policy we get, it is funded in the same manner. We understand there's going to be an increase, but just tell us the funding is the same, that it's going to happen.
Yeah, because I mean, I can talk about the plan, but then again, I had to basically get the plan from somebody else before the meeting to learn about it in order to educate myself, to educate others to find out.
Right.
They did like the IAC plan itself. They liked the $5,200 deductible versus the $6,000 deductible. They love the embedded part because if they have one family member that goes $2,650, I think it is, then they are stopped, and then the insurance plan, they loved all that stuff. Then they said, well, how much is it going to cost? Well, I can tell you it's a 26.9% increase at the bottom number, which is the $200,000 total on the plan. What does that relate to the employee? I learned today it's like 86 and
Something like
60,
that, yeah.
62. So we could come up with ballpark figures, but without knowing exactly what it's going to cost, and be able to tell the employees, this is how much the plan is going to cost. But then the other big question is, how much can the city afford? And where's the city at with this?
So as a board member, I would like to make a motion that we table till December 5th. That'll give the committee more of an opportunity to discuss with the employees to see what would be best for them, as well as the city. That would be
There's
my
a motion to table?
Mayor, I've got a question. Why haven't we been able to figure out how the city is going to handle the HSA?
Well, here's the problem with that whole thing, is the fact we have only went through claims basically till November the 15th, for example, and we gotta go to the end of the year to see what our run-out claims are. Well, we gotta come up with that money somewhere because, you know, whatever that is over and above, we're going to have to pay for that. Now, who's gonna pay for it? The city doesn't have the money to do it. We were gonna borrow from rainy day fund to do that so we could get reimbursement, but after December 31st, they will not reimburse us anything. So, we don't even know what them numbers are yet, so.
So we wouldn't really know December 5th either.
No.
So it.
Well, how are we gonna sign people up for insurance?
we
Because
have-
open enrollment
we have
starts,
to make a
what, in
decision.
a week and a half?
Yeah.
That doesn't make any sense to me.
There's a motion on the floor to table till next meeting. Ed?
I like the IAC myself, but being a person that, you know, I don't have the insurance, I'd love to have medical insurance, but to me, I'd be like Jim, I have to use mine a lot, and it's deep. And to know that might take a hit right at first, but the future is gonna be less. I don't think I would want to table it.
I think that
Myself.
I'm in agreement with Ed. IAC looks good, but what are the employees? I am concerned about what the employees are gonna pay. And if the city will say, you're gonna pay the increase, but you're also gonna get funded the way that you have for the last several years, that I can go back and go, look, you're gonna get an increase, but your HSA, the 110 or 220, and the percentage the city has done, that's gonna be in effect. And I don't know who can tell us. I
They said
understand,
they're not gonna have the number.
I understand Dan saying that it's gonna be a cost. Is there money in the rainy day fund that can be funded for a year to make up that? I don't know who decides that. I don't know if the
Council.
board.
Council.
Does the committee work on the rates?
We
Does the
can if
insurance
you ask
committee-
us to.
Is that how they've done it in the past?
No, we're doing it the same way this year. We've always done it since I've been here.
No, as far as the HSA, how much they
No,
pay and all
what
that
the
stuff.
city-
That's
No,
been a
Pro-Am.
stable amount.
It's been
Day
stable
one.
amount. In 2009, when I first sat on the committee, we worked on those, but we haven't worked on them since then, because we said it's a 20%, we're staying self-funded, and we just, the mathematical equation happens, and this is what the new number is. We have not looked at rate, we have not worked on rates in the committee, since 2009.
talking the same thing, but maybe a little different. I think what he's talking about is the cost per employee, the cost per pay period for the various enrollments. Are you talking about the total rate?
The total rate, I mean, who pays what?
Yeah, we've talked about it, only in question is the city gonna continue to pay what they have? And that would tell our employees, this is what you're gonna pay.
No matter what insurance you have, both parties are gonna pay more.
Oh, they understand that. It's 46,
With one
20.
exception, and that would be the United Healthcare plan that's about where we're at now. And saves the 26% increase, or 46.
I would,
And that's
I
the
would
one
not
to where
support
you
United
have your
Healthcare.
co-pays and can be more expensive. I'm not gonna say it is, it can be, and if you have a baby and things like that, it could be
Well,
costlier.
Let me just give you my spill on it. Our HSA contributions, approximately 150,000 a year. If we got 300,000 in run-out claims, that's 2 years' worth of HSA contributions. So unless someone else has got an idea where we can get this money from, I would say that there's gonna be an additional cost, until them are satisfied.
Is it something that the rainy day fund can fund, and then over the next 2 or 3 years, it be repaid?
That'd be
That's
up
the way
to
it's
them.
set up, but if the
We can't,
council approves it,
Mark,
they have to be
we
repaid.
can't answer that question. That's a council issue.
Right.
So do we have to wait until the 5th? I mean, can we all?
Well, here's I appreciate you wanting to table the 5th to give us more information, but it's per diem, we're not gonna have more information to give. I mean, I can go and present the plans, and I can already tell you the plans, that the people would be interested in. But as far as how much it's going to cost, we know it's a 26.9% increase. It's $200,000 total into the thing, or what he's talking about, which is you go to the insurance company itself, it would maintain the same, or we stay self-funded, which is a 46.9, 9 or 5% increase? 46% increase. So I know what the employees are gonna say. They would say, oh, well, I asked the closer plan structure, we would want that, but I can't tell them how much it's gonna cost them out of their pocket.
My bottom line right now, without knowing what them numbers are, I would say it's gonna be a 26% increase, and no HSA would be my guess unless someone else can come up with,
And it's gonna be the same way with the 46%. It's gonna be that, plus they're gonna lose the 110 or the 220. So
that's for a 1 year though. And so that would lower the premiums down to a cheaper amount. It wouldn't be a 46% increase.
right, but then the employees are gonna lose their money, the city pays them for their HSA, which is a nice plan. We appreciate it. But then, either way, if the city can't afford it, the HSA donation or deposit into our account, you're gonna lose either one. And then you have your 26 or 46 increase. And I know what we've talked about previous weeks and then today. They want the smaller increase.
Well,
I'm not gonna say smaller,
I can only,
less higher.
you can only base it on you three employees.
Right.
I can't read their mind. They're not here, so I don't know what they want. And they need to come and tell the
Right.
board what they want.
I agree. They were here last Monday. The room was almost full.
There's a motion on the floor to table until the next meeting, till December 5th.
I'm not gonna approve the motion.
And then the motion's withdrawn. Any other motions?
I'll make a motion to vote tonight on the Beech insurance.
Okay, a second?
I'll second.
Can
On-
you wait a second, we need to know which
Okay,
insurance you're talking about.
would be the IAC plan.
Okay.
A motion to accept the IAC plan? Second?
I'll second based on the nods, yes, that I'm getting from the representatives.
All those in favor signify by saying aye.
Aye.
I also vote aye, and the motion carries. And I suspect this week you should proceed. Okay.
Getting on this right away for our employees. We will need to know the contribution amount, the employee premium contribution match to the health savings account plan, and the employee premium contributions as well, so we can.
How about if we meet sometime in the middle of the week?
That would be fine.
Thursday, Thursday'd be bad, Sometime this week. Could you correspond with Dan? We'll set up a meeting. There is no other order of business this evening?
I got one
Okay.
question first. Now, when will the open enrollment be?
As soon as we can determine your employee, which is up to you, your employee premium contribution strategy and your HSA contributions, the employees need to know that, and we'll put that into our employee presentation. And I assume, you want Plan B and Plan F, once you determine which plans were, which are the plans that I presented. HSA Plan F.
Question.
Once we have that information, we can set dates and get open enrollment meetings going for them, so we can build the.
If the city's contribution to HSA for employees goes away, is the HSA still there, or is it just traditional?
No, yes, it would still be there, the account would be in place because you've elected to have a high deductible health plan. And with that, means you are eligible to have a health savings account to help pay the expenses, whether it's the employee or the employer contributing to that HSA account. So you would still have Plan F in place with the $2,600 and $5,200
So the city does not have to contribute to that unless they wish to.
Just as you don't have to contribute to your plan right now.
Right, correct.
Well, Dan, would it be, go ahead and, would it be acceptable to go ahead and say that for 2017, that's not going to happen?
I think that would be appropriate, and, you know, we'll see what we can do on 2018, because we're going to.
I'm talking about the city's contribution, HSA, to the employee would go away in 17 to offset the increase, what do they call it?
The run out money.
Run out.
So if it's, I'm just using 150 for example, and we got a $300,000 run out, it's gonna be 2 years of contribution to cover that.
Mark, are you clear on that? Jim, are you clear on that? Aaron? Okay.
But it would be for any of the two that would come into play. It's just no contribution at all, correct?
That's the way I'm assuming it would be.
Ed and Sandy, are you clear on that?
Yes, yes, I am.
So whatever rate she's got in there would be the rate your employees would pay, the 26% increase.
I don't think that's exactly precise,
All right, what are we missing?
because she showed a total premium.
Right. That's what I'm saying, the number is not broken down, what the total premium, how much the city contributed, if it's an 86%, it's an 82%, and then also you break down your family, because you have to take out your individual portion of it, then you gotta bring in your family percentage, and you've gotta run through the math to figure out the actual percentage of what the employee should be paying. And that's what I was asking for all along, and that's what we needed the information for in order to talk to the employees about.
I mean, our team can help you run those numbers if you would like assistance in running those. I'm sure that as the benefits consultant, Christian can too, what your breakdown is, so we can.
That's what we're asking.
If you would run those numbers and then sooner than later, present them to the clerk, please. Then I would expect a phone call for open enrollment very soon.
Yes, I would like to get those meetings in place. I will have a team with United Healthcare and our benefits consulting team coming in, so we'll set the dates and we'll set the number of employee meetings that you'd like to have and what time you would like to have them, because we certainly understand that there's many shifts, so we can be in here in the morning, afternoon, late afternoon, whatever works best to make sure all the employees see the presentation and have the opportunity to ask questions about United Healthcare or the plan.
Okay, very good.
So we'll set those dates.
Board members have any other questions?
Thank you all for being here and helping through this. It's not easy. It's not easy. So, Christian, thank you. Ann, thank you as well, the committee.
Ed, comments?
Not this evening,
All right. Motion to adjourn.
I'll make said motion.
and I'll second.
Meeting is adjourned at 7:20.